We're looking at a pretty wild paradox today. Over the last century, our trading technology has evolved so much it's almost unrecognizable, right? Yet the one thing that truly rules the market literally hasn't changed a bit. Human emotion. We absolutely love to think our advanced tools give us this massive edge, but as we're about to see, the true edge lies somewhere entirely different.
We're going to cover 6 key areas today. 1. Technology changes, humans do not. 2. The disease of tickeritis. 3. Building the inverted pyramid. 4. Bulls, bears, and herds. 5. The casino of speculation. And finally, 6. Mastering the human element. Let's get started.
All right, Section 1. Technology changes, humans do not.
It's undeniable that the speed of information has just drastically accelerated. I mean, today we're trading using AI and algorithms that execute in literal microseconds. A century ago, traders were relying on paper certificates, telegrams, and the slow, clunky tick of a mechanical machine. We've gone from the steam age to fiber optic speed. Yet, despite this massive leap, the actual shape of financial crashes, manias, and booms remains absolutely identical. It's like a giant puzzle where the pieces look different, but the final picture is always the same. The patterns haven't changed simply because the core driver hasn't changed.
This quote really hits the nail on the head. The tools have changed, human nature has not. Sure, artificial intelligence can process financial statements in fractions of a second, but it cannot eliminate human greed. Every single price on a screen, no matter how fast it gets there, ultimately reflects a human decision driven by hope, fear, confidence, or regret.
Which brings us to Section 2, the disease of tickeritis.
Now, what's really interesting about this is that we often assume constant access to data makes us smarter, right? But it can actually blind us. Enter a very clinical-sounding behavioral flaw called tickeritis. It's defined as a mental intoxication caused by watching price fluctuations. Think about it. Just like putting a camera way too close to an object completely blurs the picture, obsessively watching a stock ticker restricts your vision to this hyper close-up view of immediate conditions. You entirely lose your broader perspective and start confusing a temporary wave of market hysteria with a company's true value.
The source text uses this incredibly vivid metaphor to describe it. Watching the ticker is like standing and intently watching the water flow over Niagara Falls. It literally hypnotizes you. Today, of course, that means staring at a glowing smartphone app. This constant, relentless visual stimulation draws traders right into the current. It disorients their reasoning and prompts them to commit these completely fatuous blunders that they would never, ever make if they just took a step back from the screen.
Moving on to Section 3, building the inverted pyramid.
So this psychological disorientation usually results in what we call the inverted pyramid. Now, the ancients very wisely built pyramids with the heavy, solid end on the ground, right? But the mesmerized modern speculator does the exact opposite. First, they buy a small, safe amount at the bottom. As the price rises, they feel validated, they're feeling good, so they buy more. Then, at the very top, overcome with total euphoria and greed, they leverage everything they have to maximize their position. And because the heaviest financial risk is now balancing at the very tip top, the entire structure completely collapses on the very first market dip.
To give this abstract trap a real human face, consider the tragic parable from the text of a young, confident trader, a real Lochinvar of the market, who bought Lake Copper stock. He starts off buying at just $5 a share. As rumors start swirling and the price climbs, he just keeps pyramiding. He cancels his sell orders and buys more at $50, then $75, then $85. By the time it hit $94.50, he was massively leveraged. When the stock inevitably crashed, well, his top-heavy pyramid fell right along with it. He lost absolutely everything, and that stock eventually bottomed out at 90 cents. Ouch.
Let's move to and see how this builds in Section 4, bulls, bears, and herds.
In the market, there are generally 3 distinct classes of losers. First, you have the ignorant, who blindly follow rumors. Second, the cynics, whose monumental arrogance just completely blinds them to reality. But the third class, actually, this is the most fascinating one, the knowledgeable. These are folks who understand the theories, they know the precedents, they have all the data perfectly dialed in, and yet they still lose. Why? Because brains and knowledge are entirely useless without temperamental discipline.
And this lack of discipline is wildly magnified by the crowd. The source text beautifully juxtaposes 2 market states here. On one side, you have the bullish herd. They are delirious with joy, running on blind enthusiasm, just stampeding together to buy at the very top. On the other side, you have the lone bear, the investor actively betting against the market. Operating against the herd is terrifying. You're just facing limitless risk as the market irrationally climbs higher and higher. Metaphor is perfectly illustrated by the story of the leather merchant. This guy was an astute, self-made businessman. He had an iron nerve. He rationally deduced that stocks like Bethlehem Steel were wildly overvalued back in 1915, so he bet against them, shorting the stock. But the market just went mad with prosperity. He stubbornly kept doubling his short position as the stock soared to $100, then $200, then $500. His rational mind simply couldn't accept the market's irrationality. Finally, when the stock hit $600 a share, his nerve broke. He collapsed, and his entire million-dollar fortune vanished. It just goes to show, rational people can absolutely be destroyed by irrational markets if they lack emotional flexibility.
But hey, it's not just the bears who suffer. Consider the sheer agony of the sold-out bull. The texture is a story of a veteran trader who bought Union Pacific stock, rode it all the way up to a massive $100,000 profit, and then wisely sold. But the stock kept rising. The psychological torture of watching others make money on a stock you sold too early. It's described as being like a bulldog chained in a kennel watching a fight. Driven totally mad by the fear of missing out, this experienced trader panicked, re-entered the market at the absolute peak, and lost nearly all his previous profits. Just brutal.
Let's pivot to Section 5, the casino of speculation. 20 grand. $20,000. That is the amount a deeply methodical, disciplined, and totally conservative businessman lost in just a few hours at a Monte Carlo roulette table. Now, he had a strict rule going in to only risk $200. But after a losing streak, his psychology just snapped.
He started throwing 1,000-franc notes wildly onto the table, almost completely unaware of what he was doing. Which really begs the question, why do methodical, seemingly rational people completely lose their minds under pressure?
And this brilliantly illustrates the real reason the house always wins. Yeah, sure, there's a mathematical edge, but the real house edge? That's human psychology. Excitement causes mental confusion. Players will double their bets during a bad run out of sheer frustration, or they plunge stubbornly when their good luck inevitably turns. The house wins because human beings collapse emotionally, and you know what? This applies perfectly one-to-one to stock speculation.
Which brings us to our final part, Section 6, Mastering the Human Element.
Look at the stark contrast between these two mindsets. The emotional speculator is hyper-focused on the fluctuating ticker price. They're constantly chasing trends, and honestly, their only real goal is selling to a greater fool. It's just a frantic guessing game. The rational investor, on the other hand, focuses on intrinsic business value. They wait patiently. In fact, the text likens them to someone sitting calmly, simply observing a troubled sea, just waiting for the storm to pass before acting. I know, it sounds boring, but it's exactly what creates long-term wealth.
So the crucial point is this. Your greatest investment edge has never been hidden inside some secret algorithmic formula. You are not going to beat an AI at processing speed, and you definitely cannot predict every macroeconomic shift. Your true edge, the one that actually matters, is emotional self-mastery. It's the ability to step away from the ticker, resist the herd mentality, and actually manage your own greed and fear.
Which leaves us with one final essential question you really need to ask before you make your next trade. Are you actually competing against the market, or are you just competing against yourself? Master yourself, and I promise you, the market becomes infinitely easier to navigate. Thank you so much for joining me, and I truly hope this helps you keep your head while everyone else is losing theirs.